channel. I'm Professor Don Bush. Been teaching accounting for about 30 years, been a CPA for about that long, and I've got great ways to explain accounting. So today we are studying the cash flow statement financing activities, the third and final category of the cash flow statement. So this is at the intermediate level. So hope you guys learned something today. So here we go. What we need here to do financing activities, we need two balance sheets. We need a balance sheet from the prior year, balance sheet from the current year. We're going to look at the change between the two. And what we're focusing on are long-term liabilities and stockholders' equity. These are the only two categories that we need to look at. Fortunately, the financing activities tends to be the easiest section of all to do. So let's see what's going on here. We've got mortgages payable was $25,000, now $22,000. The change is a drop by $3,000, a negative $3,000. So it appears that mortgages payable is being paid down. And what we need to do is we need to look in the general ledger, the general journal entries. We need to talk to people. We need to look at documentation to find out if this is what really happened. But fortunately, I provided some extra information for you so that way we can get down to it. So here's some information. So Fred here paid dividends to shareholders in the amount of $5,000. Let's see here. Here we go. So with number 2 here, mortgage payable balance paid down by $3,000. Well, that explains the drop in the $3,000. And while we're at it here, let's go back up here to number 1. One thing that we need to know is, did Fred's company here, the snowblower company, did it pay out any dividends? Well, where do you find dividends? Well, you would look at the statement of changes in stockholders' equity. That would tell you if any dividends were paid out. And it looks like Fred paid out $5,000 worth of dividends. So that's going to be very important here. $5,000 in dividends paid. And of course, we have the mortgages payable that was paid down by $3,000. So let's see what else we have. We have note payable. Note payable was $6,000 and it grew to $10,000, and the change is a positive $4,000. There we go. So the change is a positive $4,000. So we have to see what happens. So we'd have to look in the general ledger, look at journal entries, talk to people, look at documentation, try to figure out what happened here with the note. So let's see here. So note number 3 here, note payable balance was paid down by $1,000. However, $5,000 was borrowed. So if it was paid down by $1,000 and $5,000 was borrowed, that would explain this $4,000 increase in that account. So we need to have this on our cash flow statement because these are cash transactions paid down by $1,000 and $5,000 borrowed. So deferred tax liability, I don't have that highlighted because this is not going to go in the financing section. Now it looks like deferred tax liability was $4,000 and now it's $3,000, and so it went down by $1,000. So apparently they're paying this deferred tax liability. But this deferred tax liability is going to show up in the operating section. It's kind of the only exception that I know of a long-term liability ending up in the operating section. And so we're not going to use it today. The bonds payable was $50,000 at the beginning of the year, $50,000 at the end of the year, no change, so we don't need to worry about it on our cash flow statement. Common stock, coming down to common stock here. Common stock was $10,000 at the beginning of the year. Now it's $12,000 for a gain of $2. Now we've also need to look at this additional paid-in capital because common stock and additional paid-in capital go hand in hand. Common stock is the par value and additional paid-in capital is any amount over and above the par value. So they're both tied together. They're not just related, they are really tied together. And it went up by $1,000. So what we'll say is that it looks like they probably sold stock, probably for a grand total of $3,000. So let's look at the notes to see if that is true. So here in note number 4, Fred sold shares of common stock for a total of $3,000. That explains that $3,000. Coming down the balance sheet here, we come down to retained earnings. And folks, retained earnings, we really never look at this for the cash flow statement. I would totally stay away from it. We don't need it for the cash flow statement. Everything that we need from retained earnings, we already have. We already did the net income when we did the operating section. We just did dividends. So there's really no reason to look at retained earnings to do the cash flow statement. So we will ignore it. Treasury stock. Treasury stock was 8,000. Now it's 9,000. Looks like it gained by 1,000. What the heck is treasury stock? Well, treasury stock is stock that the company buys back off the market. So whenever treasury stock goes up, that means that Fred's Snowblower Service is buying stock off the market. So it costs money to do that. So when you see an increase in treasury stock, that costs money. In fact, we have a note here in regard to that. Treasury stock was purchased for $1,000. So let's come down to the cash flow statement. So here we go. We're not doing the operating section. We're not doing the investing section. We are just doing the financing section. That is it. And I'm going to split the screen so we can see what is going on. So here we go, folks. So cash provided by financing activities, dividends paid were $5,000. Where did we get that? We got that from note number 1. And if you're wondering where we got note number 1, it would have come off the statement of changes in retained earnings. Decrease in mortgages payable, $3,000. Here we go. Mortgage payable balance was paid down by $3,000. There it is. It also matches over here with the accounts. Now the increase in note payable, I've got it listed at a net amount, and I've seen it listed this way on cash flow statements, and I've seen it listed out separately. But let's see where that came from one more time. Here we go. Note payable balance was paid down by $1,000. However, $5,000 was borrowed, so there was a net increase of $4,000, a positive $4,000. And then coming down to the stockholders' equity section, here we go. Common stock and additional paid-in capital, they are tied together. Sold common stock for $3,000. There we go. And treasury stock, whenever the company buys treasury stock, that costs money. So here we go. Purchase treasury stock, $1,000. And it looks like if we add it all up, it comes to cash provided used by financing activities of $2,000 grand total. So there you go. There's the financing section. So what goes in the financing section in a nutshell? Long-term debt and any transactions that have to do with owners. So there you go. So I'm going to unsplit this, and just for review here, what the heck are the other sections of the cash flow statement? Well, the first section is cash provided by operating activities. You start with net income or net loss, add back non-cash expenses, add back losses, deduct out gains. You have to look at current assets. Did they go up or down, and account for them appropriately? You have to look at current liabilities. Did they go up or down, and then account for them appropriately? And then cash provided by investing activities. That has anything to do with long-term assets, buying and selling long-term assets. Property, plant, and equipment, fixed assets. And so you want to think of investing activities not as investing so much in Apple stock or Amazon.com stock, but rather investing in yourself, investing in your company by buying long-term assets. So there you go, folks. There's the lesson for today. Hope you enjoyed it. If you did, hit that like button, hit the subscribe button, and until next